All right, why don't we dive in and get started? Welcome, everybody. Glad you're here. I am Kaylin Jordan with Hunter Benefits, and over the next half hour, we're going to talk about something that most of us don't spend much time on, 403(b) plans. And honestly, once I started digging into research for this webinar, what I found surprised me, and I think it'll surprise you too. If you have any questions, just hold them for the end, and we'll have plenty of time to get into them. So first thing, before we dive into the presentation, I wanted to get a better idea of what sectors you're working with when it comes to 403(b) plans. And if you don't see it up here, you can feel free to tell us that in the chat. So if you could put a one down if you're primarily working with K through 12 or higher ed, two if it's healthcare, three for nonprofits or religious organizations. Okay. I'm seeing more threes. Okay. So it looks like nonprofits are what most people and religious organizations are what a lot of people are dealing with. Great. Definitely keep in mind the clients that you're already working with as we go through the presentation, but I'd encourage you to also to think of the other boxes that you maybe don't work with as typically and think about the potential there as we're going through the rest of the presentation. So, the big headline before we dig in, there are nearly 160,000 403(b) plans in this country with 1.5 trillion in assets, and most of them have no advisor of record. That is a lot of money left on the table. The stacking options on these plans and catch up are a little advanced, I'll be honest, and Christopher wanted me to flag that up front. But we don't shy away from complex at Hunter Benefits. We embrace it. And one other thing I want to leave you with today, if you find one plan with no advisor, you fix one problem, you will meet five more organizations just like them. That is genuinely how this sector works. So let's get into the how. When you think about who sponsors a 403(b) plan, I want you to think in these three buckets. So, governmental entities, things like public schools, state universities, they are always ERISA exempt. Nonprofits, which is where things get a little more interesting, and then churches and church-related organizations, they have their own rules. A key point to take away from this is not every 403(b) plan works the same way, and ERISA does not apply to all of them. That distinction matters a lot, and the next slide will spell out those distinctions. So I want you to think of this as your 403(b) cheat sheet, your time saver when you're trying to figure out what applies to a client. So ERISA coverage, as you can see here, is not automatic. If it's a government plan, it is never covered. Churches with no ERISA election are also exempt. And here's the road to really focus on nonprofits that add an employer match. In most cases, adding employer contributions mean the plan is no longer exempt and ERISA fiduciary rules apply. That decision brings a whole set of responsibilities the plan sponsor often doesn't realize they've taken on. And that is really your opening. You're not selling them something they don't need. You're telling them that they just created a legal obligation and you can help them meet it. Advisors who understand this are genuinely rare in this space, and that knowledge alone can really set you apart. So this is where 403(b) plans step into what I like to call their Jerry Maguire moment or their show me the money moment. Um, you can see here that base deferral is 24,500. Over 50, you add that $8,000 in catch up, so that gives you 32,500 total. Secure 2.0 creates a super catch up for ages 60 to 63, which is an extra 11,250 instead of that 8,000, and that brings that total to 35,750. That super catch up window doesn't exist in a 401(k) in the same way, But the thing that makes a space really different is the 457B stacking. So eligible employees can contribute both to a 403B and a 457B independently. So that means 24,500 to each. So that's 49,000 combined at the base level before any catch-ups. You really cannot do that anywhere else in the tax code. That's really unique and it starts a compelling conversation with potential clients. So I wanted to go through like two more real world examples of what this would look like for real people. So at the top, you can see a hospital CFO, age 58. They get 24,500 to the 403B, same amount to the 457B. Plus, because of their age, they qualify for that catch up. So they're getting 8,000 catch up on the 403B side, another 8,000 catch up on the 457B. That gives them 71,500 deferred pre-tax this year. Um, and one thing to know to stack the catch up on a 457B, it must be a governmental plan. Those are the only 457Bs where that option applies. Um, Second, you can see a nonprofit executive director age 45, so there's no catch up. They still have that combined base between the 403B and the 457 that brings them to 49,000. And when you can show someone a real path to deferring that kind of money, you've really changed the conversation. It's not, just compliance anymore. It's more of a conversation about wealth planning, and that sticks with people. So as of 2026, this catch-up Roth mandate is live. So it's definitely not something to put off. Any employees who earn over $150,000 in the prior year have to make their catch-up contributions as Roth, so not pre-tax. That means current year tax deductions on those contributions, which, changes the math for some people. So two things to check. Does the plan sponsor know that this rule exists? And does their record keeper or their payroll provider support Roth accounts? Because not all of them do. If they don't and they have high earners making catch-up contributions, that's a compliance problem in the making. And that's honestly our bread and butter at Hunter Benefits is seeing those problems ahead of time and helping you avoid them. So in terms of safe harbor, safe harbor eliminates most non-discrimination testing. Everyone has to be allowed to enroll and contributions have to be applied consistently. For smaller employers, especially, nonprofits and schools, this is the simplest path to a clean, compliant plan, and it's definitely worth bringing up early. So before 2009, 403B plans had almost no oversight. So vendors sold annuity contracts directly to employees, and plans ended up with, 10, 15, sometimes 20 separate providers. Each have their own fees, each have their own contracts, and there was nobody that was watching the whole picture. So the DOL now requires fiduciaries to monitor every investment option, including those old contracts that nobody has looked at in years. And if a plan can't account for all of them, that is a fiduciary breach. So, I think a question worth asking an HR director is how many vendors does your 403B plan have? And if they look at you blankly, that's your moment. And what you're offering, it isn't just cleanup. Making their plan ERISA compliant protects the employer from liability. Consolidating vendors simplifies everything for that HR director. And, it opens up real savings options for their employees that they probably don't have right now. So when we think of 403B plans, there are three levers. First, as we were talking about, the safe harbor match design. So that's 100% on the first 3% and then 50 on the next 2%. That gets you out of most testing and gives employees a plan they can understand. The second is auto enrollment. New 403B plans are required to start participants at 3% under Secure 2.0. And a quick note, Secure 2.0 created those startup tax credits for new plans, but nonprofits can't use them because they don't pay income tax, so the credit doesn't apply to tax exempt entities. But auto enrollment credits can still apply. And third, and this is really the part that I think makes people lean in a bit more, for governmental plan participants, you can add a Roth option. And like we talked about earlier, you can stack a 457B and layer in employer contributions. So that total annual limit goes up to 119,000. That's only available in governmental plan. It includes the super catch up as well. And for the right person, that number changes the entire retirement conversation. I wanted to, give some insight from my own experience. So before I was in financial services, I spent my career working within a nonprofit. And, these organizations run on trust and word of mouth in a way that a lot of other sectors don't. So executive directors and staff, we share everything between organizations that we work in coalition with, vendors, accountants, and even advisor recommendations. So if you look out for one organization and help them, you will get a call from somebody that they know. That word of mouth is very real in that space. Something also worth kind of keeping in your mind is what makes a 501c3 qualify as a C3 is that their mission is focused on education and public benefit. That's what distinguishes them from like a C4. So if you're coming in with real knowledge, that really resonates with their identity as an organization, and that will definitely help you get your foot in the door. And I can also say from being a person on staff, the gap is really real. So when I knew nothing about my retirement plan when I worked at a nonprofit, and we probably had one slide at a staff meeting that was rushed through, and usually HR directors couldn't answer a lot of the questions that staff had. That's still the norm. And if you show up to a meeting with somebody in this space with clarity and a plan, I can pretty much guarantee you that it is at least going to get you a meeting and a foot in the door. So here are three real scenarios for conversion. So a community hospital with 300 employees, they probably have 8 to 15 vendors that nobody's watching and no advisor of record. You can walk in as the fixer, consolidate those vendors, help the organization get their plan under control. You reduce risk, simplify oversight, and you become the person that they rely on. For K through 12, 80 employees, it's ERISA exempt. You could propose a modest match. Um, and that creates a need for a plan advisor, and you just kind of made your own role there. And then with a regional nonprofit, that has 50 employees, most have never heard of a 457B plan. So you can explain that their executive director could defer an extra $24,500 a year on top of the 403B. And that's really a retention conversation that gets you in front of leadership and it gets you into the room where decisions are made. So I know that was a lot. A quick recap of the kind of high level key pieces here. First, you should always verify ERISA status. Employer type and whether there's an employer contribution determines, everything about how the plan is regulated. Second, the 2026 limits are really compelling, and with super catch up and a 457B, a client can defer up to 71,500 this year. Most people in these organizations have never been shown a number like that. Third, if anyone in your client's plan earns over $150,000 and is making catch-up contributions, check their record keeper and their payroll provider now. The Roth mandate is active and not every platform is ready for it. And fourth, a plan with multiple vendors and no oversight is a fiduciary problem, and it's definitely your entry point. Okay, so now my mouse wants to get lost. All right, so I would love to know if you could put in the chat, after hearing all of that, thinking about your clients, what do you feel like is your most pressing 403B need right now? So if you think it's a RISA status review for a client, you can put A in the chat. If vendor consolidation support would be more helpful, B. And then for plan design or catch-up modeling, you can put C in the chat. Okay. I had a feeling it was going to be catch up. That's what we guessed. Okay. All right. That's super helpful. And if there's something that we missed and you're like, you know what I actually need is this thing, you guys didn't even talk about it, then like put that in the chat too. But with that being said, I'm gonna open it up to questions. Don't all jump in at once. CIT availability. Robin, do you want to jump in on that? I don't know what does CIT stand for? Collective Investment Trust. That I could get back to you with some additional information on. We could probably ask Christopher, right, Robin?
Yeah, yes.
Yeah. Yeah. So, Mallory, I can email you. So ERISA is not determined by if they complete the Form 5500.
Yeah,
Robin,
they
you're taking.
yeah,
Yep.
they will if they are covered by ERISA, there will be a 5500 form. So that's what we usually find. If there is no 5500 form, it's probably a non-ERISA plan.
Um, we could follow up with everybody who came to the webinar with that info on the CITs available for 403Bs if that's interesting to everybody. Bo, your question, are you seeing 50C3s choosing 401Ks over 403Bs in any instances? Honestly, I can just speak from my limited experience being here. I've only had one client kind of in this space and they were a 457. So I can't say that, but Robin, you,
We have had people, there's been a discussion of which one, a 401k or a 403b, because of the testing that may be required with the 401k, depending upon what's happening with the 403b. But otherwise, they're very, very similar, other than the fact that you can't do the stacking with the 457 that Kaylin had brought up.
yeah. And I can say when I was in a nonprofit, I had a 401k. I had never been on a profit with a 403b. Robin, do you want to jump in on this question?
I have to, we have to get back on some of these questions.
Yeah. These are great though. I'm excited that you guys are asking us questions that are kind of stumping us. We got to go to the big wig with it. Um, but that, yeah, we can follow up with the answer to that one too. Awesome. Anything else? I hate to have you guys keep asking questions that like we don't necessarily have the answers to at our fingertips, but we will get you answers.
Christopher is really the expert on all this stuff, and he's at a conference in Chicago right now. So
Yeah. So you're stuck with me. Sorry.
when we share the slides and the resources for this webinar, we'll include all of these questions too.
Yeah, absolutely. These are great questions. Anything else? I'll take ones that are stumpers too. We don't shy away from the hard questions. Okay. I'll just move forward to the next slide, but if you have questions, just jump in. And all it is this is a schedule of our upcoming webinars. We've had a lot of people ask about cash balance plans. Um, so next month on the 20th, the third Wednesday, Christopher will be leading that one. Um, we would really encourage you to come. This is the one we've been asked for the most. So any of your friends that like deal with cash balance plans, we're going to be dealing with the cash balance king. That's what we call Christopher around, or that's what I call Christopher. I want to take full credit if he doesn't like that nickname. He seems to like it, but yeah, exactly. It's a pretty good name, right? I feel like he needs like maybe for this webinar we need like a crown. Um, he's not gonna like that I said that on this one. But yeah, that should be good. And then, we'll have ones every month for the rest of the year. If you have any ideas on topics that you want to hear about, we've got them scheduled out, but we're always looking for what people actually want to hear about. So feel free to share any thoughts you have on the webinar. I know Zach put in the link for your feedback too. It really helps us make sure that these are actually helping you and not just what we think you want to hear about, but knowing what you actually want to hear about really helps us make these as effective as possible. Um, if nobody has any more questions, you can feel free to hop off because we're, at the end, but you can also stay on if there's anything else you want to ask us about or talk about.